All right, why don't we get started? We have a new camera setup, which is very worrisome. There's 4 different screens up there. But anyway, today we're going to talk about ETFs. We're going to take a deep dive into some of Australia's most popular ETFs, spend a little time talking about how you can explore an ETF and use these as an example. But first, we have our housekeeping items. Anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, get a copy of our FAP from our website, morningstar.com.au. And the New Zealand regulatory authorities would encourage you to seek out a financial advisor if you would like personal advice. All right, so let's get into this. So we're going to look at some ETFs. So what I did, and these do correspond mostly with the most popular ETFs in Australia, I pulled the 10 most popular ETFs that are held by Morningstar Investor subscribers. And we're going to look at 5 of them today. And I just picked 5 that I thought would be interesting. We unfortunately don't have time to go through all 10, but what you can see here is the ETFs, the ticker symbols, and of course the Morningstar rating on them. So I think overall it's pretty good that people are holding things that are rated highly by our analysts, mostly broad indexes that they cover, but we'll dive into a couple that are not. One thing I did want to point out is we have 2 ETFs, the VGS, so Vanguard MSCI International Shares, and the Vanguard MSCI International Shares hedged ETFs. We'll talk about the hedge one today. One thing I did want to point out is they do have different ratings, and I just wanted to explain why they have different ratings, since they literally hold the same things. One removes currency exposure, of course, that hedge product that we'll talk about today, and we'll go more into what that is. But the reason they have different ratings is because, of course, we compare everything to things that are in its category. And so there's a different hedged category for all the hedge products out there. And that's why we have a gold rating there and a silver rating. So, of course, these represent our analyst ratings. Gold, silver, bronze are things that we believe are good opportunities for investors. Neutral, we are, guess what? Neutral on them. And then we have no negative ratings in here. But of course, negative are things that we think you should actively avoid. And of course, 2 are not covered. These 2 thematic ETFs. We'll talk about hack. So we'll talk about one of them today. But first off, before we get into this, of course, any exploration of an ETF needs to look at, and we'll do this today, needs to look at the underlying index. So what is the methodology for creating that index and updating that index if depending upon the index, if that's something that happens. And then, of course, we want to look at the holdings in that ETF and the underlying exposures you have. So feel free to shoot through any questions that you may have. We will, of course, record this and we'll put it up onto our YouTube site. Will said with this fancy new setup, that'll happen automatically. So hopefully that'll be up there a lot faster than normally the couple days it takes us. All right, so let's dive in. So the number 1 ETF we're going to look at, I went too far, is the Vanguard Australian Shares ETF with the ticker symbol VAS. So this also happens to be the most popular ETF in Australia. Obviously, it gets a decent rating from our analysts. It is very cheap, so there are some good things about that. And what this gives you exposure to is the broad market in Australia. So what this tracks is it tracks the ASX 300. Those are the 300 biggest companies in Australia as measured by market capitalization. So, of course, that is the amount of shares outstanding for that particular company, and then the value of that share. So you can become a bigger company by having the share price go up. So we'll talk a little bit about the Australian market, of course, which this represents. One thing I would say is, based on the size of the Australian market, in theory, what this gives you exposure to is it gives you exposure to the large cap shares, which really are represented by the top 100 in Australia. And then, of course, it gives you exposure to the 100th to the 300th largest company, which in many cases starts getting into small caps as we get closer into 300. So those are smaller companies. So it is diversified in that way, but it is market cap weighted. So once again, as I said, the biggest companies get more of the investment dollars. So basically, there's a heavier weighting to them in the index, and of course, a heavier weighting to them in the ETF, which tracks the index. So a couple of things we need to point out about investing in Australia that I think probably heard me say before, and that is sort of obvious if we look at the companies that are in Australia, especially the big companies, is it's a relatively narrow market. And we can see this through the exposure to different sectors within the market here. So what you'll see is obviously two things jump out at you: a lot of basic materials. So that is where the miners sit. And then a lot of financial services. So that's where the big four banks and other financial services sit. So you are getting a lot of exposure. And really, if we look at global markets overall, the financial services sector, everything went blank for a second. I don't know what that is. But anyway, if we look at indexes globally and we look at global markets, which we will get into in a little bit, there is a lot more exposure to financial services. There is a lot more exposure to basic materials. The other thing I'd say about those two sectors in Australia is basic materials. Of course, a lot of the commodities that are mined here are not consumed in Australia. And so this is where you're getting a lot of exposure to China, because China is overwhelmingly the consumer of choice, or the market of choice, or I guess just the market in general that consumes a lot of these raw materials. So you are getting a lot of China exposure here. In financial services, interestingly enough, you are not getting a lot of global exposure. So big four banks are very domestically focused, increasingly focused on the mortgage market in terms of their lending books. So we've seen that tick up over the years. And so just a couple things to look out for, not necessarily good or bad things, but obviously something that you should be aware of if you're investing in this index. And we can see it right here, and we'll go on to the next slide in a second and talk about it. So this is the summary section from our analyst report on Vanguard Australia shares. I highlighted this particular paragraph because the other thing that we have is, when we're investing in the Australian market, is that we have a lot of exposure to what we would call cyclical and sensitive sectors. So basically, what we've done here is we've divided up those sectors to how they are expected to perform in terms of the economic cycle. So what that means is that if you are a cyclical company, you are, of course, following that economic cycle. So when the economy is going very strongly, you, of course, reap the benefits of that. The economy is going into a downturn. You, of course, would suffer during those periods in terms of the revenue earned by these companies. And that compares to defensive companies that you would expect to do well in all economic cycles. And just looking at the sector names here, consumer defensive, so think things you need. So you need to go to Kohl's and Woolies or wherever else because you need to eat no matter what's happening in the economy. Healthcare, of course, people generally don't skip going to the doctor or getting something treated because the economy is not doing well. And of course, utilities, people like it when the lights are on. So you see a lot of exposures, and our analysts point out 84% of the assets are exposed to those cyclical and sensitive sectors, which means compared to a market that was more balanced, the Australian, not necessarily the economy, but the large companies in Australia would be more exposed to that economic cycle. So something to think about. What I would say, of course, is basic materials, because these things are not consumed in Australia. What are you really exposed to? Well, you're exposed to the Chinese economy and the market cycles that China goes through. So just something to think about. The other thing, of course, is we have a very concentrated market, which we'll get on to the next slide. Well, let's move on to the next slide. But as you can see, our analysts do think it's very difficult for a lot of active managers to beat this index and this ETF over the long term. So we've talked a lot about kind of active and passive strategies, talked about areas where active managers can add value, and that's generally not in a countries such as Australia, developed market, where you're still looking at large companies. So even though, of course, this does include those mid cap and small companies, the index is very weighted towards it. And we can see that here. So what this is taking a snapshot of, showing the top 10 holdings. So a couple things that you want to look at here when you want to start analyzing an index and analyzing what you're investing in. So we've got 47% of the assets in the top 10 holdings, right? So even though we say this is widely diversified, and in a way it is, we say it holds 300 companies, which it does. 47% of this is in those top 10 countries. So it is pretty top heavy. And we can see that when we start seeing some of the names on here. So of course, BHP, close to 11% of the index, obviously a really big driver. Then we start to see a lot of the banks in here as well. So with Macquarie, even if we're going to look at the top 10, we've got 5 different banks in there. So that, once again, is where you're getting a lot of that exposure. The other thing that that you can look at, which is particularly important as we start to look at other indexes that are a little bit different, is turnover. So turnover represents how much literally of that index is changing. In this case, it's the ETF that tracks that index. So we can look at the underlying index. How much is that index changing on a year-to-year basis? So if turnover was 100%, it would mean in this case, there would be 300 new companies in that index every year. So on an annualized basis, we are literally turning over that entire portfolio. As you can see, very low turnover. Now, we talked about this last week, and we talked about this in terms of generating income from ETFs, how because capital gains are also distributed, that really high turnover, especially in rising markets, can lead to a lot of capital gains being distributed. You're not really going to get that case when we're tracking one of these broad indexes. So a lot of the income that you will receive from this index will, in fact, be dividends, as opposed to something that is a very high turnover rate where we could see more of those capital gains, meaning we're selling things. And if we're selling things that have appreciated in value, of course, that capital gain gets passed on to you. So just a couple of things you can look at. And we actually have questions already. So maybe I'll answer a couple of questions as we go on there. So Rodney, all the questions are from Rodney. So that's good. So lots of questions from one person. So if other people have questions, and if Rodney, you have more questions, send them through. So Rodney's talking about the cost of this ETF, and he says it's incredibly low, right? So it's 10 basis points or 0.10%. So it is incredibly low, but he's pointing out that there are 2 other indexes. So there has been, and very good thing for us as investors, there has been kind of this battle for obviously market share by lowering fees. So Rodney correctly points out that there are 2 other indexes that track the ASX 200. So that's the 200 largest companies that do have lower costs. So he's saying iShares is now at 0.05. So that's half of what you're paying for Vanguard Australian shares. And then Beta shares is at 0.04. So there are lower cost options. And I think maybe this is, and Rodney's saying this in his answer, as I said, Rodney should just give these things. But what Rodney is talking about is these, of course, track a different index. But in reality, because of the way the Australian market is weighted, because there's so many assets, remember, 47% of this thing is in the top 10. Because of that, there isn't really that big of a difference between the 200 and the 300. So even though we sit there and we think, oh, it's got 100 more companies, I'm a lot more diversified, there's a tiny percentage of assets in that last 100 companies. So if you go back and look at historic returns, they are pretty close. But yeah, you can get cheaper fees elsewhere. But needless to say, this Vanguard Australian shares is still the most popular ETF in Australia. I obviously can't talk about why each individual investor has chosen it over another ETF, but this sort of fee war that we've had that's benefited us as investors has not always been that way. So this product was cheaper at one point, but now, of course, we've seen beta shares and iShares come in and undercut them and go below them. So it is a really good point. Rodney's asked, is turnover represented by the number of companies? Yeah, so it's just the holdings in that ETF. So it's not looking at a market capitalization weighted turnover. It's looking at the number of companies in that ETF, the holdings in that ETF. Really good question by Guy. I was going to get into this, but you sent the question, so that's good. So I've described a lot the Australian market, what we have in terms of exposure to BHP, in terms of exposure to the banks, and particularly in those two sectors, the 47% of assets that are in the top holdings. So what do you do about that? If this does make you nervous, what do you do about it? Or if it's not necessarily the exposure you want to get? Well, of course, you can go into an equal weighted ETF, as Guy pointed out. So MVW is an equal weighted ETF. And what that means is it's going to take the same companies. Now, in MVW's case, it's only looking at the 82 or 87 largest companies in Australia. But what it's going to do is it's going to invest in all of those equally. So basically, instead of having that market cap weight on there, it's going to have an equal weight. Now, there's a couple of reasons you might want to consider this, and a couple of reasons why you might not. So the first reason you might want to consider this is because you potentially have some sort of overlap from other products. So whether you're investing in perhaps a super fund, and this might be an investment outside of super, and the super invests in a lot of these large Australian companies, you don't want to kind of double dip. You can perhaps consider that equal weighted. You could consider that equal weighted if you own individual shares. So obviously, if I would have put that chart up there around the most popular shares that are owned in Australia, whether it's by our customers or whether it's by people in general, a lot of people have gone out there and purchased those individual shares. So they might own BHP, they might own some of the big four banks. And if you want to add an ETF to your portfolio and not double down on that exposure, that could be a reason to invest in that equal weighted index. And just more diversification at the end of the day, right? More diversification outside of those sectors and outside of these kind of household names. So if you were perhaps concerned about the future of Chinese economic growth, maybe that's something you do. If you're concerned about mortgage debt in Australia and what could happen as more and more of the bank's revenue comes from mortgages, then perhaps that's something you can do. But what it's really all about is kind of thinking about those different exposures and how that fits into your overall portfolio. And even going out there and buying both, for example, right? So if there's a certain amount you want to allocate and you want to get your exposure to some of these large companies down, and you put 50% of your money into an equal weighted ETF, not ETX. We are talking about ETFs today. 50% of your money in there, then 50% into something like VAS or one of the other large market cap weighted ETFs. That's a potential way that you could mitigate that exposure without completely going equal weighted. So there's lots of different considerations. So why might you not want to invest in that equal weighted index? Well, the obvious one, of course, is that if BHP, the banks, et cetera, continue to do really well, of course, you are going to lag from a performance perspective. But the other consideration is what we talked about last week. So you're going to have a lot higher, they're going to trade a lot more in that equal weighted in the ETF because they're going to rebalance that. And that act of rebalancing, as we talked about, is selling from companies, everything's equal weighted at the beginning of the period. And then when they go back and they put that equal weight on it again, of course, that involves selling the winners, buying the losers, the relative winners and relative losers. And of course, that can generate capital gains. So it could have a worse tax outcome for you. So just lots of different things that you can consider looking at these two products. But, you know, I think it's a good, indicator, and Rodney just said that. So once again, we just need to get Rodney in here. And now we can have a new setup with 4 cameras. So Rodney, we can be on different cameras and we can cut back and forth. But he's saying, yeah, market cap turnover is a better indicator. Yeah, agreed, looking at that tax drag, but that's really what we're talking about there. When you have the same securities, but what you're really doing is you're selling portions of one to buy another. So we've got a question saying, how can we avoid investing in ETFs that are the same companies that the funds in my super are invested in? Yeah, I mean, quite simply, obviously, it's looking at what your super is invested in is the first thing. So I can't answer what your super is investing in, but the first thing you can do is actually understand what's in there, right? So understand the exposure. So in the example I gave, your super somehow is either invested in index ETFs that are market cap weighted, like Vanguard Australian shares, or if the super is going out there and buying individual companies, right? So if they're going out there and buying companies like BHP, that's where just that knowledge of what is in your super, and then of course the knowledge of what's in the ETFs you would buy outside of super is really important to make sure there isn't that overlap. Now we have a tool at Morningstar that if your super is invested in ETFs, things like that, or if you have a self-managed super and you're buying individual positions, you can see that overlap. So what it'll do is it'll look through investments like an ETF and it'll show you, okay, well, you've got very simple example that maybe people would do. You've got half your money in this Vanguard Australian shares and the other half of your money invested in BHP, then all of a sudden you'd sit there and say, okay, well, I don't actually have a 50% exposure to BHP. It's actually up over 60% because of this ETF. So that's another thing you can do. The last thing I would say about kind of investments in super, investments outside of super is, of course, consider the tax situation in both of those, right? So if you were to hold a share or an ETF that paid very high dividends, where would you want that? You would most likely want that in super, right? Because you're getting taxed less for that. Whereas assets that were not generating capital gains, that were not having high dividends paid, you'd want that outside super, where of course you're going to pay your marginal tax rate. Now, obviously, everybody's tax situation is different, but in general, that's what you would want to do. And Simon's saying there's also X20, which is market weighted, excluding the top 20 ASX. So yeah, what we're looking at there is we're eliminating those large companies. That's also going to be a good diversifier for you if you're trying to get away from that exposure of the really big companies in Australia. So that's a really good point, Simon. So thank you for making this. All right, so we've got a question saying, what is the importance of female directors? Why is that highlighted? Well, I mean, it's highlighted for a couple of different reasons. So, number one, obviously, when we're sitting there, we're talking about executives and directors. A lot of people are interested in that information, see what kind of diversity there is in the company. There have been a lot of studies that have come out and shown the advantages of having a more diverse leadership at companies. So you're obviously not just sitting there with all the same people in some sort of, executive session where you're not getting new ideas, you're not getting fresh perspectives. So there have been a lot of studies, particularly looking at women, saying the more women that are included on the board or in the executive ranks of a company actually does lead to higher returns. So it's really just informational, but there are those studies that are out there as well. All right, so we'll keep going through. All right, number two, we're going to look at the BetaShares NASDAQ 100 ETF, NDQ neutral. So neutral, of course, is our rating. So a couple of things that jump out immediately is in terms of the cost that you're paying for this, it's significantly higher than what we're seeing around a lot of those ASX 200 or 300 ETFs. Remember, so Vanguard, we're talking 0.10, even cheaper when we start looking at that iShares and BetaShares product as well. So the cost jumps significantly. The other thing we have to talk about what the NASDAQ 100 is. So the NASDAQ, much like the ASX, is simply a stock exchange. So in the US, you've got the American Stock Exchange as well, but really the two majors are the New York Stock Exchange and then the NASDAQ. So the NASDAQ in general has traditionally listed more technology companies. That's kind of what they've been known for. Now, the NASDAQ 100 index is very different than the actual exchange where all sorts of companies can be listed on there. And our analysts talk a little bit about the rules around the NASDAQ 100. And so they're trying to do a couple different things here, right? So the ASX 200 and 300 don't have anything to do with the ASX. So what those are Standard & Poor's indexes, just like the S&P 500. So what you'll see with the full name is you'll see like the S&P 200 or the S&P ASX 200. So it's not the ASX, the company, which is publicly listed and owns the exchange. It's not the company that's actually creating the index. Now, things are a little different with the NASDAQ. So one thing, the NASDAQ 100 index, as you can read on here, is they're trying to promote their exchange. Now, you can be listed on multiple different exchanges. As our analysts point out, anyone who's listed on multiple exchanges gets excluded from this index. They also exclude any financial firms from this index. So really what this has become is it's really become kind of a proxy for the technology sector at the end of the day. And so when we start looking at sector exposure, you can see that. So we've got 47% of this index in technology sector. Communication services with 16.5%. You probably think most of those are technology firms. So Meta is in there. So that's Facebook's parent company. Google's in there. So they're not in the technology sector. They're in communication services, but many people consider them technology shares, at least in their head. So what that's doing is it's giving you a lot of exposure to what we would call sort of broader tech. Now, this has done very, very well for the NASDAQ, with the exception of 2022. So because those companies, because those technology companies have done so well, the index has done very well. And so obviously it's become very popular. But just remember, those are some of the exposures that you're getting. Now, if you're sitting there as an Australian investor, maybe this is what you're looking for, because of course, these are very underrepresented in Australia. If we go back here, we look at technology, less than 2%, communication services, less than 4%. So it is giving you exposure to a lot of these giant tech companies. So you can think about it from a diversification perspective there. What I will say is that anything in the US, so if you invest in the S&P 500, that's the 500 largest companies in the US, doesn't matter what exchange they trade on, you're still getting over 20% exposure to technology. So that's really just the makeups of markets. And it's one of the reasons why it's important to diversify, because if you do have a lot of home bias, even forgetting the other benefits of globally diversifying, if you have a lot of home bias in Australia, well, you're missing out on a lot of these big sectors. Now, if you were to take an equal weighted index, you'd have more technology exposure in Australia. There are technology companies, they're just not as big compared to the miners and the banks and things of that nature. But once again, it's one of the benefits of diversification, particularly if you have a very narrow market. And you would say the same thing if you were in the US, right? And you wanted exposure to things like basic materials, which you can see is zero here because of the nature of this index, but also a very, very small percentage of the S&P 500, that broader index in the US. So that's just giving you some of those exposures. When we look at companies, it's kind of the usual suspects of large technology companies that you can see on here, with the notable exception of Pepsi, which of course is certainly not a technology company. Amazon is not technically a technology company, right? They're a retailer. They just use technology to sell their goods, but pretty much everything else you see on here is some of these large technology companies that have done very well, once again, with the exception of last year. So something to think about with this index. Wow, we're getting lots of questions today. Yeah, so Rodney's also looking at, so once again, this is why we need Rodney doing this. So what Rodney's looking at is he's looking at the S&P 500 ETF, so IVV. So that's, once again, as I was talking about, very low fee, 0.04. So it's really showing what you are paying for this NASDAQ index. Now, why are you paying that much for this? I, of course, can't speak for beta shares, but probably because of the level of returns and the popularity of this index that they don't think they have to lower their fees, would be my guess. And also just a level of competition around that NASDAQ index. Now, remember, of course, that you are going to get all of these companies in the S&P 500. So Apple is the largest company in the US. So you, of course, would have a very large exposure to Apple, Microsoft, everything else in that S&P 500 ETF. They'd be a little less than this. We can see, once again, we're very top heavy here with 52% in that top 10 holdings. So got a good question about currency risk. I was going to cover, Eric asked it, I was going to cover currency risk later, but I'll sort of start now. So the currency exposure risk that you are going to get, so these are all US, the NASDAQ 100, because they trade in the NASDAQ. So these are all American companies. So really the currency exposure you're going to get anytime you invest overseas, unless the product's hedged, which we'll get into in a little bit, anytime you invest overseas, there is currency risk. So as Australian investors, what we want is we want the Australian dollar to weaken, in this case against the US dollar, because that is all of these companies trade in US dollars. So what we want is that Australian dollar to get weaker, and that will add to our returns. The Australian dollar goes up against the US dollar, then of course that will detract from our returns. Now, currency, of course, is kind of complicated because a lot of these companies, I've got an iPhone, I'm sure a lot of other people do. A lot of these companies, of course, sell things globally. So there's a lot of complexity around currency. So kind of specifically around, if you are, of course, a US company that is making revenue overseas, that then has to get translated, whether the money moves or not. Money can still sit in that country, but that revenue has to get translated back into US dollars. You're also going to have an impact, right, around those currency movements. But sort of the specific impact for you as an investor is how, in this case, the US dollar and the Aussie dollar move. So Lisa's saying, are distributions from the NASDAQ ETF calculated after paying non-resident tax in these foreign holdings? Yes. So basically what happens, and Shani actually wrote a really good article on this. If anyone wants, email me, I'll send it to you. But when you invest overseas, depending upon the country, countries have different tax laws, but they're going to tax you. So basically what happens is, in the US, if you get a US dividend, or if a distribution comes through this ETF, there will be a withholding tax. So basically what they're going to do is they're going to take some of that to pay taxes in the US. Now, you can generally, once again, this is not tax advice because we can't give tax advice, but generally that counts against your Aussie taxes. So you are not, in effect, doubly taxed on something. So that withholding tax, of course, you declare that when you're doing your Aussie taxes, and that will reduce the amount you're paying for your Aussie taxes. So for most countries, you are still getting taxed at whatever level you would be taxed at in Australia. Now, of course, there can be some issues with super and things like that, but in general, dividend taxes, at least in the US, dividend taxes are lower than what they are in Australia. They're taxed at a set percentage. They are not taxed at your marginal tax rate. And so depending upon how much income you make, that tax is 15% in the US, which actually magically corresponds with what most people are paying on super. All right, so Rodney's saying, so instead of buying the FANG Plus ETF, one of my favorites, you should just get the NDQ, since 52% is in the top 10 holdings, which is just about the same holdings as FANG. Yeah, very similar. So a lot of overlap between these. So really, that's why it's important to look at what's actually in these ETFs and think about how that corresponds with other things you hold and the best way to access these assets. All right, so we're moving on to a property one. And I picked a property one just to do something a little bit different. This gets our highest rating, a gold rating. We're looking at the Vanguard Australian Property Sector ETF. So as you can see, all of this is in one sector and is in real estate. Now, there's a couple things that we really like, our analysts really like around this ETF. The first thing is just, once again, looking at the overall Australian real estate sector. It is relatively small, as our analysts point out. So Australia is actually the second largest in terms of REITs, so real estate investment trusts, or in Australia, AREITs, Australian Real Estate Investment Trust. It's the second largest real estate investment trust market in the world, behind the US, but it's still relatively constrained. So there's only 47 listings on the ASX. And when our analysts look at such a concentrated market, and we'll see how concentrated it is on the next slide, the answer is very. And they compare that to other options. So this is a passive ETF. It is tracking an index. So when it compares it to an active manager that's playing in that Australian real estate investment trust market, our analysts think it's very, very difficult for an active manager to beat them because of the concentration in that index. So normally when we're looking at active managers, we're looking for very wide opportunity sets, right? So we're looking at very large choice that active manager can make to go out there and position their portfolio very differently from the index. That isn't really the case with real estate investment trusts in Australia. So we think this is a really, really good strategy. Now, not only is this a very small market by companies, when we start looking at the index is just looking at the top 30 in here. So small index, and you can see very, very heavily weighted to the top 10. So hopefully you recognize some of these names on here, but 80% of this is in the top 10. So very, very top heavy of an index, especially with one holding, Goodman, having over 25% of the index. So very, very top heavy. But once again, we think it's difficult for managers to beat that index. So we think it's a good choice. And you can see more expensive than some of those broad-based indexes we were looking at, but still not terrible. So of course, smaller than that NDQ. So I will keep moving through since, we got a couple more questions. Okay, so Rodney's saying some of the international US ETFs listed on the ASX are domiciled in Australia, so you don't need that for them, but some aren't. So yeah, one of the interesting things is a lot of people are buying, they're now buying US ETFs directly. And that can make your taxes a little more complicated. So what you're doing is, of course, now that it's cheaper and easier to actually trade on the US exchange, if you trade on the exchange, of course, you can go out there and buy a company like Apple, or you can go buy an ETF if you want, but that can also complicate your tax situation. So Lisa says, how are REIT ETFs affected by inflation's impact on property value? Okay, so it's complicated, Lisa. REITs have done really poorly. And it's not so much inflation. So there's two sides of this, obviously. There's interest rates and there's inflation. So REITs generally have very high debt levels. A lot of course, going out there and building something new, or going out there and acquiring a property, they're borrowing a lot of money to do that. Now they have assets to back up that money, but REITs don't generally do great in a rising interest rate environment. And we saw that. It's been one of the worst performing sectors last year. Now, the flip side of that is, of course, inflation that we're seeing now also. Now, inflation has a couple impacts. It can certainly impact a REIT in terms of going out there and building a new building, right? So we've seen we've basically seen construction costs go up significantly. So whether that's wages that you have to pay the workers, whether that's all the raw materials that have to go into creating a new building. Now, the flip side of that is that it often makes properties more valuable, right? So the fact that you can't go out there, and I'm making this seem simplistic, and throw up another building means that existing buildings can get more valuable. The other advantage that a lot of REITs have, depending upon the REIT, and this is where you need to look into their property holdings, what property sector investing in. So, they could be malls, they could be office buildings, industrial buildings, et cetera. That inflation can make those buildings more valuable because it costs more actually to build them. And the inflation is generally, and once again, look at the specific REIT, it is generally built into the contract. So generally there are automatic inflation escalators built into leases that people sign. Now, the advantage that you get from that is, of course, one of the struggles that companies have is, can they pass on inflation into, if you're manufacturing something and all the parts cost more and the workers cost more to pay per hour, can you pass that on to consumers? Sometimes you can, sometimes you can't. Sometimes you have to eat some of that and your margin goes down. REITs don't really have that problem. Number one, because of course they own property already, so it's already built. And yes, costs will increase to pay the security staff and maintenance and everything else, but you generally have those inflation escalators built into the contracts. So that can actually be okay for them, and it can be a hedge against inflation, as you don't have to worry about passing on those costs, are automatically built into the contracts. So yeah, REITs are a little bit complicated in an environment like this. But anyway, hopefully I hit the at least the broad strokes of REITs. All right, so we're looking at the BetaShares Global Cybersecurity ETF, HACK. Good name. Now, our analysts don't cover this, so I wrote some notes on it. All right, so what is HACK? Well, first of all, we've been hearing a lot about cybersecurity. So, of course, there's been some very well publicized major cyber attacks on Australian companies. So, of course, Medibank being the big one. So it's been in the news a lot. There certainly is a narrative out there that that the number of cyber attacks and cyber criminals out there are all increasing. So this, of course, is a thematic ETF. And what it's supposed to do is, of course, fit into that narrative. And the narrative being that companies now will have to spend more money and continue to spend more money on cybersecurity to stop some of these threats, which I think is a pretty compelling narrative. So what are you getting here? You're getting a lot of technology companies, right? As you would expect. We'll look at some of the holdings in a second. How does this thing work? Well, number one, they charge you a lot for it. So a lot of these thematic ETFs have higher costs. So you can see 0.67. So this will be our highest cost ETF of the day. How does this work? Well, there's an organization called the Consumer Technology Association. And they select companies that are primarily involved in building, implementation, management of cybersecurity. So, this in many ways is almost like an active ETF, right? That you've got this organization going out there and selecting companies. There's a couple other filters they put on there around size of companies. So I think it's 250 million US. They won't invest in a company that has a market cap smaller than that, but really being determined by this third party that's creating this index that then, of course, this ETF is tracking. Now, there's a lot of reasons why this isn't purely an index. So generally, they're very rules-based. In this case, you have this association, the CTA, that is identifying companies primarily involved in something to do with cybersecurity. We can take a look at the names. The other thing that's interesting about this ETF is it's actually a liquidity-weighted index. So when we talk about liquidity, we're really talking about like how much are these things trading? And so what they're doing is they're weighting this index by companies that trade more. There's all sorts of reasons why a company can trade more, but in general, or one big reason is there's a lot of investor interest in it, right? So you've got a lot of people in there buying and selling it. That's going to increase that those trading volumes, which is going to lead to a bigger representation in the index. Oftentimes, larger companies, of course, trade more than smaller companies. So you also have that bias, right? You've got that bias to larger companies, which isn't that different, right, than a market cap weighted index, but it's just a different way that they're doing it. What is this? it's US tech shares. And I have to get a couple shots in just because this is what I do with thematic ETFs. If you do go in and look at this compared to the S&P 500, which I did, so I went on our portfolio page and looked at the underlying statistics of the holdings in this, you are getting higher valuations. So they're trading at higher price to earnings ratios than the S&P 500 as a whole. You're getting lower return on invested capital. So remember, that's a bad thing. Return on invested capital is what is the return a company makes when they invest funds to try to grow that business. We want those returns as high as possible, right? Because we own the business. Lower return on invested capital, you're getting lower dividends, which is kind of expected, right? Because it's more technology focused, generally pay lower dividends, and you're getting a lower percentage of companies that our analysts give a moat to. So just a couple things about this. Also, very high turnover. So 44% turnover. So that means basically this thing is completely turning over in 2 years. Not quite. 50% would be complete turnover in 2 years. And really the reason for that, of course, is they're swapping things in and out of it based on decisions made by this Consumer Technology Association. So remember that high turnover and comparing to 0.49% for the S&P 500. So that high turnover, of course, can lead to more distributions of capital gains. So of course, perhaps maybe not the tax outcome you're looking for. So you could get higher distributions, even though the dividend yield's pretty low, given the companies that are in there. So what is in this thing? So you can see 47% of assets, same as ASX 200 in those top 10 holdings, relatively small, narrowly focused index, right? Only 37 holdings in this thing, pretty high turnover, and you can see what is actually on there. So some companies you may know very well. Some companies you may know just because things are popping up on your computer, asking you to check different boxes. We've got this Okta thing at Morningstar that texts me or something. I don't know. But yeah, so what you're seeing is you are seeing a lot of, as I said, a lot of companies that are involved, at least in some way, with cybersecurity. Now, hack, not great returns for some of these top holdings, but that's kind of to be expected given what's been going on in the market and kind of particularly in that technology sector. We go back and look at last year. And yeah, I mean, that's hack. I'm obviously not a big fan of some of these thematic ETFs, but clearly people that are our customers at Morningstar are, since this is in the top 10. But just remember that this is very different. And kind of same thing with VAP that we looked at before, that Vanguard Australian Properties Index, very different than these broad-based indexes. So I think certainly our analysts would say that if you are going to invest in something like this, that this is not a core position in your portfolio, whereas the ASX 200 or 300, the S&P 500 could be. So this is probably something a little more on the periphery of your portfolio rather than a core holding. So just remember, very, very narrowly focused, not a lot of holdings in there. And of course, a fair amount in the top 10. All right, so now we're going to talk a little bit about hedging. So we did mention, and I know there's some more questions on here, we did mention currency risk before. There have been the introduction of a lot of products that have removed currency risk from the equation. So remember, if you're investing internationally, you're getting the return of those underlying securities and you're getting any changes in currency, right? So any changes, and the currency obviously is changing all the time, but any changes in the currency between your home country and wherever you're investing overseas are also going to impact your portfolio performance. And this is an example where Vanguard, and lots of other people do this as well, there are a lot of hedged products. You always see something like this, HDG, they'll have a different ticker symbol. But Vanguard has introduced this product that's in the top 10 holding of Morningstar subscribers, where that currency risk has been removed. Now they have the exact same, literally the exact same ETF without that currency removed, which is also in the top 10 holdings at VGS, the Vanguard MSCI International Shares Index. So yeah, literally the exact same holdings. In this case, we've just removed currency. Now, if we kind of think about what this has done, now this is a developed market index. We'll kind of talk about that is in a second. So it's investing in a lot of different countries, but it's very, very heavily weighted to the US. So that's 70% of this is actually in the US, even though it invests in 22 different countries. So really it's that Aussie dollar, US dollar that's going to drive those currency returns. So they're removing that. They're using derivatives basically to remove that currency and hedging it. There is a cost associated with it. The cost is not that much at the end of the day. So people are able, or companies are able to do, companies like Vanguard, able to do this very efficiently. So really, I wouldn't say the cost in any way is prohibitive to do this. It's really sort of what your notions are about currency. So that can either be because you have a view on currency, you have a view on what's going to happen with the Aussie dollar. And in this case, you would be thinking, if you were investing in this product, the Aussie dollar is going to get stronger over global currencies, particularly the US dollar. So it could be a view around currency. The other reason you might want to use this is based on your life. And the example I always use, which maybe is simplistic, or maybe I'm just trying to think about myself, is when the Aussie dollar is falling, so it's getting weaker against global currencies, that of course adds to your returns. That's a good thing. The bad thing, of course, is if you want to go anywhere else and spend money. Right. So all of a sudden your trip to Europe or your trip to the US is going to cost a lot more if the Aussie dollar gets weaker. So sometimes it's people just kind of thinking about their life. Also, if you're consuming a lot of goods from overseas that are being imported into Australia, those could potentially cost more as well. So it's something else you can think about as you're considering this. If we go and we look at the companies, we look at this group of companies, the top 10 companies, all American. So as I said, this is 70% US. And the reason it's 70% US is, one, the US economy is large, and particularly the portion of the US economy that goes to publicly traded companies is pretty large. But also just because the US has outperformed. So remember, anytime you're in a market cap weighted index, if something outperforms on a relative basis, so, if we look at the other big holdings in this in terms of countries, it's Japan, the UK, Canada, things like that. If the US stock market does better than the UK market, for example, it's going to make up more of that index because it's market cap weighted. US has outperformed till last year, has really outperformed since the GFC. And so what you've seen is the US creeping up in terms of that weighting. So this is certainly more diversified. You can see that there are over 1,400 holdings in this, only 16% in the top 10 holdings. So very different than what we've seen in some of the other ones we've looked at. But remember, primarily US does give you sort of wider exposure and diversification than if you were investing in like the S&P 500, for example. But this is, once again, a time where you want to think about your overall portfolio. You've certainly made a lot of your portfolios allocated to the US, for example. If you've gone out there and bought an S&P 500 ETF, for example, well, in some ways you're kind of doubling down there. And there are lots of products out there where you can invest outside of the US. So internationally from Australia, not including the US. So you can kind of think about how you want to balance that portfolio and just make sure that everything that goes into your portfolio has a purpose. So we do want to, of course, we do want to make sure that we do have diversification, but realize a lot of these things double up, especially when we're talking about all these market cap weighted indexes with some of the, I guess, imbalances from a market cap perspective in the world. So David has a question. When you mention most popular, are you basing this off of net flows? No, so I'm actually looking at holdings of Morningstar Investor subscribers. So it's not net flows. Now, if I was to do this, I probably wouldn't be looking at net flows either. If I was going to do this Australia-wide, what we'd probably look at is assets. So net flows means how much is going in versus how much is going out. But what we'd probably look at as the most popular, we would look at it based on how much money is in there. So as I said, Vanguard Australian shares, most popular holding in terms of Morningstar Investor subscribers, also the most popular ETF at this point in Australia. So hopefully that answered your questions, David. Lisa said one might say Australia's economy runs on holes in the ground and holes in people's pockets. Donald said, well said, Lisa, but I agree. Yeah, so Rodney's got an interesting point. Obviously, you guys can see this in the chat. Yeah, I mean, why did Australia avoid a bad recession after the GFC? It was before my time in Australia, but not before my time on Earth. Yeah, obviously, the mining boom really helped Australia avoid that recession. And if we look at last year, like the Australian market looked very different and looks very different than like the US market, for example. So that overweighting to technology caused the US market to be one of the worst performing markets globally last year, because those technology shares are really the ones that did poorly. So obviously anything can happen going forward, but this stuff does have an impact. Now, the argument, of course, is that the US outperformed for so long. Did last year really matter? Well, it depends on your perspective. And as we looked at even the US market, and I think I talked about this, I talked about this in a podcast that we're releasing on Sunday. If you go and you look at different parts of the US market, the NASDAQ performed a lot worse than the S&P 500. Why? Technology did poorly. It's heavily weighted towards technology. If you go and you look at the S&P 500 dividend yield index, it's looking at the highest yielding shares, that was only down like 6% last year, compared to a 20% drop in the S&P 500, compared to over a 30% drop in the NASDAQ. Last year also did not look as bad if you were an Australian investor in an unhedged product, because the Australian dollar got a lot weaker against the US dollar last year, which insulated you from some of the returns. So if we go back and look at that hedge product that we're looking at right here, compared to the unhedged product, the hedged product did better. I'm sorry, the unhedged product did better than the hedge, because those currency movements actually benefited you. So yes, it's a 1-year period. We need to be careful about looking at 1-year periods, but I think understanding the things you're investing in, understanding those underlying holdings in an ETF is a really important thing. And really important, so that when things happen like last year, or even when we have very good years, that you understand the source of those returns that you got and why certain products performed the way they did. And you really need to look at the exposures in them and what's in the ETF to understand that. And that's really important as investors, right? We don't want to base our decisions solely off of performance. We want to put some context around that performance in order to figure that out. So Justin has a question. What are your thoughts on Vanguard's VDHD as a ready-made diversified ETF, as it's a collection of Vanguard's Australian international hedged and unhedged, plus some exposure to international small caps? Yeah, so what basically Vanguard has done is they've created this product that's really kind of a wrapper, as Justin said, to all of these other ETFs that they have. And the idea is, of course, that this is widely diversified. So instead of going out there and buying these individual ETFs, that you can follow this ETF. I have no problem with that. What I would look at is make sure that those asset allocation decisions they're making, just like if you were in a pre-mixed option in your super, if you had like an industry super fund, make sure you understand those underlying exposures. So same thing that we're talking about here, and make sure that asset allocation is appropriate for you. So yeah, I certainly have no problem. It makes things easier in terms of simplicity, but just like going in and picking the balanced option at Aussie Super without understanding what that is, just look at those underlying exposures and make sure that's right for you. But yeah, I've got certainly no problem with that. All right, we've hit time. Emily's getting bored. She's had to stare at this giant screen that now has 4 pictures of me. But thank you guys for joining. So if you have any questions, shoot them over to me at mark.lamonica1@morningstar.com. We are kicking off Income Month next month. So we've got a whole new set of webinars, all talking about income, which I know is popular. I like income. Believe it or not, they actually pay me to do this. And yeah, we can talk about income. So anyway, thank you guys very much for joining. Appreciate it. And send me a question if you have any, and we'll put this on YouTube.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.